So let's say I'm going to put there's 5 on hand. When I say there's 5 on hand, QuickBooks will actually make a journal entry to record those 5, which will be an increase to inventory, and the other side's they're going to have to put the other side, somewhere for the purchase price. So it's actually going to record a transaction. So be careful when you do that. But I want to put them on hand so I can sell some of them. Let's save it and say, all right, we saved it. Let's close this out. And then we're going to say, let's say there's 5 on hand now, you can see, right? And so I sold 2 of them. And let's say, so that's going to be a sales price of $300. Sales tax is being applied with the check mark, which is driven by that item, noting that we talked about the fact that we would have to set up the sales tax in order to get that in place, which we'll talk more about in the second half of the course. And so what's the journal entry here? This is the point we want to get at. We're selling it for $300, but now sales tax is being calculated at $24. Because it's 8% sales tax. The rate will change depending on where you're at. We'll talk more about that later. But just from a generic standpoint, what's that going to do? Well, that means that we're going to have to collect $324. So it's an invoice. That means accounts receivable is going to go up by $324. The other side's going to go to revenue, but it's only going to be for $300, not including the sales tax. And then the sales tax is going to increase a payable account for like sales tax payable, a liability. Not only that, but accounts receivables, but the inventory is going to go down, not by the $300, but by the cost, which I think we said was $100, so it would be $200 for 2 of them. And the cost of goods sold, the expense is going to go up, so the impact on net income is going to be $300 minus the cost of goods, minus the inventory or cost of goods sold, which is $200, and we're going to have the subledger that's going to break out the information by customer, in this case customer 2 for accounts receivable, and a subledger for the inventory, which is going to record the reduction of inventory. So let's see if we can see that from a journal entry over here. So I'm going to put the inventory on the books again. I'll just imagine that we had like 500 of inventory, and I'll put the other side into equity as our starting point. So what's this going to do from a journal entry? What are the accounts that are affected? Usually we can break it out into 2 sides, even though they're happening at the same time in a perpetual inventory system. So accounts receivable is going to go up, and the other side is going to go to income, which I'm just going to put generically income this time. And we said accounts receivable is going to go up by, this is going to be what did we sell it for? We sold 150 times 2. Times the sales tax, which I think they had at 8%, which is 1.08, 108%. So that means we're going to collect 324, right? 324. But the sales side is only going to be equal to, I'm going to say negative for a credit, 150 times 2. And then the sales tax is going to be a liability account, which is going to be the difference, negative sum. That way I could do it, or it's going to be equal to the negative 150 times 2 times the sales tax, which is 0.08, 24. So this ties out. So debits equal the credits. And then I'm also going to have the cost of goods sold and the inventory. Cost of goods sold and inventory, which I can think of as another transaction in essence. For the inventory is going to go down by the cost, which was, 100 times 2. And so there it is. So let's think about this one. So, okay, now so I'm going to say accounts receivable is going to go up by let's just go ahead and delete this one so I can see one at a time. Let's undo that. Let's just delete it here. And so I'm just going to say the accounts receivable is going to go up by 324. The income is going to go up, increasing net income by 300. It's a credit, but it's increasing net income. And then on the liability side, sales tax payable is going up by the 24. And then we've got the inventory going down by the 200 in dollar amount. And then we've got the cost of goods sold going up. So what does that mean? It means on net income, there's an impact of $100. It went up by 300, down by 200. Net impact on net income was a net increase of 100. The accounts receivable went up by the amount plus the sales tax, 324, that we're going to have to then track on a subledger by customer to try to collect on it. The difference went to the sales tax payable, and that I'm going to have to track in like a payable account, sales tax payable, because I'm going to have to pay it to the government who forced us to collect that 24. Now note, you might say, hey, look, why don't I have $300 of income? Why don't I record 324 of income and then record sales tax expense of $24? That would make sense if we try to say that the sales tax is a normal business expense, but the government is trying to say it's not. They're trying to say you're just a collection person. So we're not charging you a tax, we're just making you the tax collector is the idea. So therefore it's off income statement, and they put it on the books as this liability. That's how they want to see it, basically. Okay, so that's what we do. And then we have the inventories going down. Notice the inventory is going down in dollar amount here, but I'm also going to have to track the fact that it goes down in units with a subledger tracking the inventory by unit. All right, so let's go back on over and say, okay, that's kind of a lot going on. Let's save it and close it and then check it out. So if I save it and close it and I go to my balance sheet, run it, and we go in, is that my balance sheet? That's not, yeah, it is. Let's go into the accounts receivable. And what do we got? There it is, customer number 2. There's the invoice. It's on there for $324. That's the full amount, including the sales tax, closing that up, and then going back. The other side's on the income statement. Run it to refresh it. This time it went into a sale of product, 300. So that's in there for 300. That does not include the sales tax. That's just our side of the transaction, not including the sales tax. The 24 is the difference. So if I go back, and then go back to the balance sheet, that's on the liability side for the Board of Equalization, which is the vendor who we pay, the government in this case, because it's in California. There's the $24 difference. So that ties out now. Debits equal the credits, or the double entry accounting system assets are going to equal liabilities plus equity with that transaction. But we also have inventory that's going to be going down. So here's our inventory account. If I go into that, it's going to be going down by 200. Note that 200 is not on the books. It's not on the invoice, because we don't put that amount on the invoice, such as or similar to when you check something out at a grocery store. You don't see the sales, the cost of goods sold, how much it cost them. You only see the sales price, but it's being recorded at that point. Let's go back and back. The other side's going to the invoice for the cost of goods sold. Cost of goods sold, there's the 200 here. All right, let's go back to the balance sheet. Also, we've got accounts receivable that's being tracked by who we sold it to, which would be on the subledger. So if I update the subledger here for the accounts receivable, we're going to have customer 2 is now in place. So if I track it by customer, we see 5,805.52 ties out to what's on the balance sheet, 5,805.52. We would more likely track that internally on the first tab under the sales, under most likely invoices, sorting the invoices by not due yet, and we can then find our invoice here that we can then hopefully receive payment on, or track it by customer and then see our customer down here that has not yet paid us. We're looking by customer, open invoices, and then we've got customer 2. There it is, boom. And then if I go into that customer, we see, of course, the invoice. All right, going back, we also need to track this inventory by subledger. So if I go back to the first tab, I'm going to go down to the reports, and I like to just type it in. This is going to be inventory valuation summary report. And so date, let's bring it up and then run it. So there we have our inventory, 3 units left because we put 5 units on the books when we added the inventory, and then we sold 2 of them. And that adds up to a dollar amount of $896.25. If I go to the balance sheet, there's the $896.25. So that is that. So actually an invoice, particularly if there's going to be inventory, is actually quite a complicated form in terms of everything that's happening, but should be very easy to input if everything has been set up properly, meaning we properly set up the items in particular, as well as sales tax or any kind of consumption tax if that's going to be applicable. If that's the case, then the idea is that when people do the data input over here for the invoice, it could be a stupid kid, or not a teenager or something, right? They're not stupid. They're just they just don't know what's going on. They're like, oh dude, I'm just entering the invoice. They don't know that all the stuff that's happening, but that's okay. That's all they need to know. They just need to get the invoice in there, and because we set up everything properly, it should be easy to do the data input. So that's going to be the basic idea. We'll talk about how to set up the behind the scenes stuff more later, which means the item, the sales tax, in the second half of the course when we set up the new company file.